Every April, millions of Americans do the same thing. They hand over thousands of dollars to the IRS, stare at the number, feel sick, and then go back to work to earn it all over again. But here's what your accountant isn't telling you at that meeting. The U.S. tax code is not written to collect money from everyone equally. It is written with hundreds of legal exits built directly into it. Exits that wealthy Americans use every single year to pay effective tax rates of 1%, 2%, sometimes 0%. And the most infuriating part? Every single one of those exits is available to you right now. You just haven't been shown the door. The first strategy is one of the most powerful tools in personal finance and one of the least understood. It's called the Roth Conversion Ladder, and once you understand it, you will never look at retirement accounts the same way. Here's the problem with the traditional 401k or IRA. Yes, you get a tax deduction today, but the IRS is not forgetting about that money. When you retire and start withdrawing, every dollar comes out as ordinary income, taxed at whatever rate exists decades from now. The Roth IRA works the opposite way. You pay taxes on the money going in, but everything inside grows completely tax-free. And when you withdraw in retirement, not a single dollar of tax owed. Now, here's where it gets powerful. If you retire early, or if you have a year with unusually low income, a gap year, a sabbatical, a career transition, your taxable income temporarily drops. Maybe you fall into the 12% bracket or even lower. That is your window. You convert money from your traditional IRA into a Roth IRA during those low-income years, paying tax at 12% on money that might otherwise be taxed at 22%, 24%, or higher in the future. Do this strategically over 5 to 10 years, a technique called the ladder, and you can move hundreds of thousands of dollars into a permanently tax-free account at a fraction of the cost you'd otherwise pay. The IRS allows this. It has always allowed this. Most CPAs will only suggest it if you specifically ask. This is the strategy that quietly makes real estate one of the most tax-advantaged asset classes in the entire U.S. economy. It is called depreciation. And it is genuinely bizarre when you understand how it works. The IRS assumes that physical buildings wear out over time. A residential property, in the eyes of the tax code, deteriorates over 27.5 years. A commercial property, over 39 years. So every single year, you are allowed to deduct a portion of the building's value from your income, even if the property is actually appreciating in value, even if it is generating positive cash flow, even if nothing is physically deteriorating at all. You are deducting a loss that doesn't really exist. On a $300,000 rental property, that's roughly $10,900 of phantom expense every year. Available to offset your rental income completely, and in some cases, offset your regular W-2 income too. And it goes further. A strategy called cost segregation allows you to accelerate this depreciation, front-loading years of deductions into a single tax year. Real estate professionals and high-income earners use this to generate paper losses that wipe out hundreds of thousands of dollars of taxable income. Totally legal, built into the tax code, barely discussed outside of wealthy investor circles. Nobody talks about. Most people know that long-term capital gains, profits from investments held longer than 1 year, are taxed at lower rates than ordinary income. What most people don't know is that for a significant portion of Americans, the long-term capital gains rate is 0%. Not reduced, not lower, zero. In 2024, if your taxable income is below $47,025 as a single filer, or $94,050 for married couples filing jointly, you pay absolutely nothing on long-term investment gains. Think about what that means in practice. If you have a year of low income, you're between jobs, you took time off, you're in early retirement, and you have appreciated stock or investment assets sitting in a brokerage account, you can sell those assets and realize the gains completely tax-free. This is called tax gain harvesting, and it is the mirror image of the more commonly known tax loss harvesting strategy. You can also combine this with the Roth Conversion Ladder. In the same low-income year, you harvest gains at 0%, convert traditional IRA funds to Roth at 12%, and potentially reduce your future tax burden by tens of thousands of dollars in a single calendar year. This is what sophisticated financial planning actually looks like. It is entirely legal, and it is entirely available to anyone who understands the brackets. If you have any self-employment income at all, freelancing, consulting, a side business, even occasional gig work, this strategy could be the single most powerful tool available to you. It is called the Solo 401k, also known as the Individual 401k. And it allows self-employed individuals to shelter an almost shocking amount of income from taxes every year. Here's how it works. As an employee of your own business, you can contribute up to $23,000 per year in 2024, or $30,500 if you are over 50. That comes straight off your taxable income. But here's the part most people miss. As the employer of your own business, you can make an additional contribution of up to 25% of your net self-employment income, up to a total combined limit of $69,000 per year. On top of that, your business can deduct its share of contributions as a business expense. So, on $100,000 of self-employment income, it is entirely feasible to reduce your taxable income to under $20,000, moving yourself from the 22% bracket all the way down to the 10% bracket, or off the tax rolls entirely if you combine this with other strategies. No loophole, no gray area. The IRS designed the Solo 401k specifically for self-employed individuals. Most people who qualify for it have never opened one. If you have access to a high-deductible health insurance plan, there is an account available to you that has a tax advantage that literally no other account in the U.S. tax code offers. It is called a health savings account, an HSA, and it is the only triple tax-free financial vehicle that exists. 1. Your contributions go in pre-tax, reducing your taxable income immediately. 2. The money inside grows completely tax-free, just like a Roth IRA. 3. Withdrawals for qualified medical expenses come out completely tax-free. In 2024, you can contribute up to $4,150 as an individual or $8,300 as a family. If you are over 55, you can add another $1,000 on top. Now, here is the strategy that wealthy people use and almost nobody else does. They pay their medical expenses out of pocket, not from the HSA, and let the HSA investments compound tax-free for decades. Then, at age 65, the HSA converts to function exactly like a traditional IRA, allowing withdrawal for any purpose at ordinary income tax rates. But all those years of medical receipts, they never expire. Decades later, you can submit a lump sum of documented medical expenses and withdraw that entire amount completely tax-free as a tax-free reimbursement of expenses you paid years ago. It is a completely legal long-term tax arbitrage strategy, and almost nobody outside of financial planning circles knows it exists. The big picture. Why this knowledge is power. Let's bring this all together because the real lesson here is not about any single strategy. It is about the compounding effect of tax efficiency over a lifetime. A person who earns $80,000 a year and blindly pays every tax dollar the IRS asks for will hand over roughly $1.2 million in taxes over a 40-year career. A person with the same income who uses a solo 401k, an HSA, a Roth conversion strategy, and basic capital gains management, depending on their situation, they could reduce that lifetime tax bill by 30%, 40%, sometimes more. That is not a small number. That is a retirement. That is generational wealth. That is the difference between a comfortable life and a dynasty. The tax code has always been written in two languages, one for people who don't know the rules and one for people who do. Today, you learned the second language. What you do with it is entirely up to you.